Well, the way I look at it is not so much how high it can go, but how low the dollar can go. And in that, because really, it's not gold going up so much. I mean, obviously, gold has a volatility of its own, but it's actually quite low. But most of the move is actually due to expectations of lower currencies in terms of their purchasing power. That's something which is really driven by foreign interest. Now, for some time, we have seen the People's Bank of China buying gold, but they're not really buying gold. What they're doing is they're dumping dollars. And I think if you understand that distinction, then you actually get the story. That's the whole point about what gold is doing at the moment. Now, we had a very interesting moment when I think it was just after Liberation Day, when we saw the dollar fall and bond yields rise. Now, I mean, this, as far as market participants are concerned, shouldn't happen. If you get rising bond yields, you would expect to see the dollar rising. But what it was foreigners dumping US investments and dumping the dollar. And that was the key to it. Now, we've got a pause in that situation. And the pause, I suppose, is understandable given that Trump is backing off on tariffs. How much, we really don't know. He seems to have come to some arrangement with China, but we don't actually know what it is. But it looks like China's, if you like, control of rare earths has upset Trump's plans. But there is another thing in this, and that is that Trump is a spendthrift. He wants to cut taxes. He wants to eliminate income tax, indeed. I mean, part of his whole tariff plan was to return to the situation before the First World War, when there was no income tax and the federal government, if you like, earned its revenues in tariffs. But that's no longer the global situation. The global situation is actually extremely dangerous. And I think what we're beginning to see is the global economy fraying around the edges. And I think we're beginning to see that, from various other major economies, we're beginning to see them stall. But this is very, very important, because as these economies stall, the US economy is likely to stall as well. It's bound to, for the same reason, basically because of the consequences of tariffs and responses to tariffs and so on and so forth. Now, what this means is that there will not be the increase in the revenue from the private sector to support the cost, just the interest, if you like, the accumulating non-paid interest on government debt. So in other words, the slightest hint of a recession and the US government is in a debt trap, which basically leads to bond yields spiraling higher. And I would argue that that is already the situation. It's just that people don't really realize it yet, but they will wake up to it. And at that stage, we will have the situation again, whereby you see the dollar falling and bond yields rising. And they'll be talking about inflation, because what is inflation? Inflation basically is a fall in the purchasing power of the currency. So this is a situation which, of course, markets do not expect. If you talk to people in markets, they're saying, oh, we expect there will be 2 quarter-point cuts in the Fed's rates this year. Well, that may well happen, but if it happens, what happens to the dollar? It's down the tubes. We go back to the dollar. The dollar is in a very, very bad position. So one way and another, I think this is just a pause. The trend, I think, when it resumes, will be extremely upsetting for not only the dollar, but also all financial instruments, dollar-denominated financial instruments. And by the way, that includes the equity market, which was very, very overvalued relative to what you get in bonds, without bond yields rising any further. It's a very, very important point. And remember that on the US Treasury's own tick figures at the end of March, they reckoned that $17.6 trillion of foreign investments is in US equities. Are they going to hang around and watch this? I think not. So pause, and I think the trend is going to continue, and it's going to be a nasty trend.
If you really want to understand what's driving gold, and by extension silver, higher today, you have to begin by flipping the common narrative on its head. It isn't really gold that's going up, it's the dollar that's going down. And indeed, it's all fiat currencies that are losing purchasing power at an alarming rate. The gold price, in dollar terms, is merely the most visible scoreboard of that decline. You know, it's quite amusing to watch Wall Street commentators every day scratch their heads and attempt to come up with fresh reasons for why gold's risen by another $20 or $50. You'll hear talk of inflation expectations, or safe haven demand, or perhaps geopolitical tensions. All of these sound bites circle around the real issue without ever quite daring to state it plainly. The problem is the currency itself. We're witnessing the consequences of decades of monetary profligacy in the West, coupled with an increasingly clear geopolitical backlash from countries who've simply had enough of funding our deficits. The Chinese have figured it out. The Russians have figured it out. The Saudis, Brazilians, Iranians, and even to some extent the French are waking up to the same conclusion. They no longer wish to accumulate ever larger piles of IOUs denominated in a currency that can be created without limit by Washington and spent on deficit after deficit forever. Look at what the People's Bank of China has been doing. It isn't so much that they are buying gold, although that is the mechanical part of the transaction. What they are truly doing is dumping dollars. And there's a crucial psychological pivot there. Once you see it not as China buys gold, but rather China sells dollars and buys gold instead, the entire global monetary story becomes painfully obvious. This is why I often remind people that gold is not rising in price so much as the dollar is losing credibility, because the dollar isn't just the US's problem. It's been imposed on the world as the primary reserve currency. Everyone from Saudi oil barons to Vietnamese furniture exporters to German car companies are forced by the architecture of global trade to accept dollars in settlement. And when they accumulate more than they wish to hold, they typically buy US treasuries. That's long been the cycle. But cracks are everywhere. In fact, we had a particularly telling moment just after what some dubbed Liberation Day, when the dollar dropped even as US bond yields rose. Now, under the typical textbook scenario, one that's taught in business schools the world over, rising US yields should strengthen the dollar. After all, higher returns ought to pull in more foreign capital. But that didn't happen. Instead, what we witnessed was foreigners dumping both US bonds and dollars. They weren't chasing higher yields. They were exiting the risk altogether. That's a significant inflection point, and it portends a rather unpleasant conclusion for investors wedded to the old playbook. We have entered an environment where higher interest rates in America are no longer viewed as a virtue that strengthens the currency. They are increasingly seen as a symptom of US fiscal sickness, a desperate attempt to compensate creditors for the accelerating deterioration of the government's creditworthiness. You see, this is the inescapable math. America is simply too deeply indebted. The Trump administration made it worse, to be sure, with vast spending ambitions, combined with tax cuts that were never offset by equivalent reductions in expenditure. The goal at one point seemed almost quaintly libertarian: to fund the state with tariffs, returning to a pre-income tax era reminiscent of the early 20th century. But that approach is thoroughly incompatible with the complex global trade web of today. The world is far more interdependent, and supply chains are hyper-optimized. So instead, what we ended up with was a series of ill-considered trade skirmishes that achieved very little beyond further stressing an already fragile global economic machine. And now, as global growth sputters, with China facing property implosions and Europe grappling with an energy-induced malaise, America is also at severe risk of a slowdown. Yet the difference is that the US government has an unprecedented pile of debt to service, with interest alone projected to consume a staggering share of tax revenues. Any hint of a recession now brings us face to face with a debt spiral. Tax receipts decline, deficits balloon even faster, and the market forces yields higher to compensate for growing default or devaluation risk. And that's precisely where gold shines. Not because it's some speculative asset that delivers a coupon or a dividend. Quite the contrary. It shines precisely because it is a monetary asset without counterparty risk. It is no one else's liability. It's not a promise to pay later. It simply is. Which is why, when trust begins to fray in the US fiscal situation, investors from Zurich to Shanghai instinctively shift more of their reserves into gold. What most people fail to appreciate is that inflation isn't about rising prices. It's about a falling currency. Prices are merely the mirror that reflects that decay. When you hear talk of core PCE or CPI ex food and energy, it's all designed to obscure this very basic reality. The dollar, like the euro, the yen, or the pound, buys you less year after year because the supply of dollars is always engineered to grow faster than the underlying economy. That's by design. It's the mechanism that allows governments to perpetually live beyond their means.
Okay, well, it's been priced only really as an industrial metal. And as an industrial metal, it has been suppressed. And I think that the guilty party is China. Bear in mind that China in 1983 gave the People's Bank of China sole responsibility for acquiring gold and silver on behalf of the state. And so I think it has been dealing with silver not only as an industrial metal, but also as, if you like, a precious metal, which is in reserve number 2 to gold. And bear in mind also that China was last on a silver standard in 1935. So this is actually quite recent, if you like, in the long history of China from Confucius days until now. So you can see that that's the case. Now, we know how, or at least I know how they accumulated gold. They had a bear market. They started doing it in 1983. You had inward investment, which, because the other thing that the People's Bank did was it controlled completely foreign exchange transactions. And so everything, all foreign exchange transactions, inward investment, and so on and so forth, all went through the bank. And later on, of course, as these investments, factories and so on and so forth, bore fruit, and exports started increasing, that again was foreign exchange transactions going through the People's Bank of China. So it was quite easy for the PBOC to accumulate gold. The mystery has been how they've done it with silver. And I think the answer was quite simple. If you go back 20 years or so, you'll see that virtually every country in the West gave up processing silver or made it more expensive simply because it's a pretty dirty business. But the Chinese basically were quite happy to import loads of silver doré and refine it for themselves. And the way they controlled the market, I think, was really quite simple. They would work with a major bank like JP Morgan. JP Morgan would, on behalf of the Chinese, sell forward to, in theory, cover their position in silver. But of course, it was actually just a suppression scheme. So what you had was silver doré bypassing the market, but the hedging going into the market and driving down the price. I think it was really as simple as that. Now, China, I think, is changing that. And I think that we got a very clear signal when President Trump had his Liberation Day. At that stage, I think that China, even though perhaps before it was already beginning to scale down its sales of futures, if you like, and other means of controlling silver, I think it was scaling it down. And I think that that Liberation Day basically meant that China came out of the market and was no longer suppressing silver. And so we can see that further moves have taken place, such as the Shanghai Gold Exchange saying that it will open vaults outside China for the first time. And at the same time, the Shanghai Futures Exchange has said that it will open itself up to foreigners participating on that market. Now, you could participate in it before, but you would have to set up a Chinese entity in order to deal. You couldn't deal direct. That's now gone. So these are very, very important changes. And I think that it's not just gold, and actually it's not just silver, it's the whole of the metals complex that is likely to be affected this way. So I think with silver having been left behind because it's been suppressed over a long period of time, we got to the point where the gold-silver ratio was up at 106. It's now fallen down. It went down to about 90. It's about 93 at the moment. I think that's going to go a whole load lower because people who've missed the boat in gold are going to say, well, silver hasn't gone up that much. We ought to get into that because look at the gold-silver ratio. It is still far too high. So that's, I think, roughly where we are. It's actually a very good outlook for the price of silver. And it's a turbocharged way, if you like, of getting out of credit, getting out of fiat currencies.
Now let's carry this forward. Because everything we've discussed so far is essentially the stage setting for what I see unfolding over the next several years, quite possibly even accelerating within the next 12 to 24 months. And it will be a period, I believe, that historians will look back on as the final chapter of the dollar-centric monetary system that began in earnest in 1944 at Bretton Woods, limped along post-1971 when Nixon closed the gold window, and is now gasping under the weight of its own contradictions. You see, what's extraordinary here is that this isn't purely about markets in the abstract. It's about human behavior under monetary duress, under the growing realization that the currency in their hand or the numbers in their savings account do not have the solidity they once assumed. This is what makes these cycles so ferocious. Because money is not just an economic tool, it's psychological. It's deeply tied up with our sense of safety, of planning, of providing for family. When that confidence gets tested, people react with extraordinary speed. In the West, particularly in the United States, we have grown accustomed to believing that inflation is largely under control, that the dollar will always be the ultimate backstop, and that treasuries are the safest asset on earth. This is pure habit, a multi-decade conditioning born out of post-war prosperity, the petrodollar system, and the sheer momentum of America's economic primacy. But we're now at the uncomfortable juncture where those pillars are cracking. Let's take the bond market, because it's the center of gravity for everything else. As we touched on earlier, America's federal debt is no longer a modest backdrop. It's an oppressive mountain, with interest costs themselves threatening to become the largest single item in the budget. And what's extraordinary is how rapidly this is shifting. Just a handful of years ago, when rates were pinned near zero, debt service was a manageable annoyance. Now, with Treasury yields north of 4.5% on the 10-year, it's a fiscal hazard of existential proportions. And foreign holders, who for decades were reliable recyclers of trade surpluses back into U.S. debt, are growing wary. China has been quietly reducing its Treasury holdings for years. Japan, too, is selling at the margin, in part to defend the yen. Meanwhile, the Saudis and other Gulf states have begun recycling more of their surpluses into direct investments or gold, rather than treasuries. The ultimate irony is that by weaponizing the dollar through sanctions, seizing Russia's foreign reserves, for instance, the U.S. actually accelerated this trend. Many countries rightly concluded, if it happened to Russia, why not us? Now consider what this means. If foreign buyers are less inclined to fund U.S. deficits, then the domestic market must absorb more of this issuance. But American households and pension funds are already heavily invested. So either yields must rise to entice ever more buyers, putting upward pressure on mortgage rates, corporate borrowing costs, and ultimately strangling economic growth. Or the Federal Reserve must step in as buyer of last resort. But that simply means printing dollars to buy debt, which, as we all intuitively understand, is the very definition of debasement. So you see, it's a trap, a debt trap to be precise. The U.S. can't grow out of it, it can't inflate its way painlessly out of it without eventually destroying confidence in the dollar itself. And so when you hear Wall Street economists on television saying, "We expect the Fed to cut rates twice this year," they're often ignoring the second-order effect. If the Fed cuts aggressively in the face of still stubborn consumer price inflation, or in the face of a renewed commodity rally, the dollar could fall precipitously. And that, ironically, would push long rates higher as foreign holders demand compensation for the currency risk. This is why I say it's not really about how high gold can go. It's about how low the dollar can sink in real purchasing power terms. Because gold itself is largely inert. It doesn't change. It simply sits there as a monetary constant, immune to default, immune to dilution. The same cannot be said of fiat currencies. And it's precisely this dynamic that is beginning to be understood by central banks worldwide. You know, the World Gold Council just reported that 2023 and early 2024 set all-time records for central bank gold buying. Many people treat this as a curiosity. They shouldn't. Central banks, for all their flaws, are among the best resourced and best informed market participants on the planet. They have entire departments dedicated to macroeconomic modeling, foreign exchange flows, and geopolitical risk assessment. If they are pivoting to accumulate gold at record pace, it is because they see structural threats to fiat reserves. This brings us neatly to silver, because here is where the story becomes truly asymmetric. As we discussed in Part 1, silver has been treated almost purely as an industrial commodity for the better part of 40 years. China, through clever strategies that combine physical accumulation with tactical short selling via proxies like JP Morgan, was able to keep silver prices depressed even as it built its strategic stockpiles. Western refiners largely exited the space, handing the keys of silver processing to Chinese smelters. And because the paper markets in London and New York allowed enormous unbacked positions, essentially silver IOUs with no physical metal behind them, the actual spot price was suppressed below what true market clearing levels might be. But cracks are showing. The Shanghai Gold Exchange opening vaults outside of China, the Shanghai Futures Exchange welcoming direct foreign participation, the steady rise in physical delivery requests on COMEX. These are not random anecdotes. They're signals of a system straining under its own leverage. You know, people often ask me to forecast prices. Alasdair, do you think silver can go to $50 or $100? And I always say, you're asking the wrong question. The right question is, how fragile is the current pricing architecture? Because if the entire pyramid of synthetic silver claims collapses, the price won't merely drift higher, it could gap violently as traders scramble to secure actual bars. And when that happens, $50 will be just another stepping stone. Look at the gold-silver ratio again. It touched 106. Historically, it's averaged more like 15. Even if we take a more conservative 45-1, roughly the average over the last 200 years, that still implies silver in the $75 range today, given gold's $3,380 price. And should we ever retest crustal abundance ratios or the medieval monetary ratios that hovered around 12-1, you'd be looking at silver well north of $250 an ounce. Now, am I predicting that? Not precisely. Markets rarely move in neat straight lines or honor tidy historical averages. But what I am saying is that silver remains the most asymmetrical monetary asset on the planet. A modest allocation today could dramatically alter the purchasing power profile of a portfolio should even a fraction of this reversion occur. Meanwhile, on the ground, the players with the best information are already acting. Look at the import quotas China is issuing to its banks, vastly expanded from years prior. According to Goldman Sachs, China bought 30 tons of gold in March alone, 5 times more than its official disclosures. In April, it was 127.5 tons. And while we don't have perfect visibility on silver, because China smartly buys doré and concentrates that circumvent typical reporting channels, private intelligence from traders in Hong Kong and Shanghai suggests they're vacuuming up every available ounce. Ask yourself, if silver at $34 were truly fairly valued, would the Chinese state be going to such extraordinary lengths to corner future supply? Would it be instructing banks to ramp up imports to levels unseen in modern times? Or would it perhaps be relaxing and letting the West enjoy its illusions? All of this brings us to the investor psychology piece, which frankly is often the most important determinant of timing. Silver is notorious for its volatility. It shakes out the weak hands. It tests conviction. And right now we're seeing precisely that dynamic. Many retail investors, exhausted after years of seeing silver capped by relentless future selling, have simply tuned out. Some have sold in frustration, some remain but have lost heart. And that, ironically, is precisely the emotional backdrop you often see just before a major move. Because metals bull markets are different from equity booms. Stocks rally on greed. Metals often begin on fear, and then become turbocharged when the crowd belatedly realizes what's happening and piles in. That's why there's a saying, there is no bull market like a metals bull market. The fundamentals are powerful, but the emotional shift is what delivers the truly outsized returns. I'll close by saying this. The endgame here is not some catastrophic Mad Max scenario, though many gold and silver enthusiasts sometimes talk in those dramatic terms. It's more likely a profound monetary recalibration. The dollar will survive, of course, but at a meaningfully lower purchasing power level. Bondholders will bear the brunt, seeing real returns deeply negative for years. Equity investors will learn that nominal gains can coexist with genuine wealth destruction if measured in real terms. Those who prudently allocate today into tangible monetary assets, particularly gold and silver, will simply find themselves ahead of this curve. They will preserve optionality. They will hold liquidity that's respected everywhere from New York to Shanghai, from Riyadh to Zurich, and they will sleep a bit better at night knowing that their financial security is not solely tethered to the promises of over-indebted governments. So if you've stayed with me this long, congratulations. You're already ahead of 95% of market participants who still don't grasp these dynamics. Continue educating yourself. Look at the data. Follow the central banks. Not their words, but their deeds. Watch where the flows go. Because in the end, as always in markets, the money tells the truth. Now is not the time for complacency. It's the time for quiet, deliberate action. Because once this monetary transition moves from the specialists and sovereigns into the broad retail consciousness, the moves will come too fast for most to adjust.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.